Hey YouTube, what's happening? Chris here. I want to bring you all something that I've been studying, working on. It's the falling wedge. And what I'm going to do, I'm going to go through the Encyclopedia of chart patterns and talk about what it says about the falling wedge. We're going to go through all the percentages, throwbacks, pullbacks, all different types of stuff. Guys, this is really good information. I want to share it with you. I really think these tutorials are important. The people who watch these, I'm really proud of you because you're studying hard, you're working hard, you're not just saying, you know what, I'm a moon boy and we're going to the moon all the time. You really want to learn, and you really want to learn trading. So I'm happy to be here with you. I want to share this stuff with you, and I'm going to do the best that I can to present it to you. So if you like this, guys, if you like these tutorials, give me a thumbs up. I want to try to get 100 thumbs up for these tutorial videos so we can get them out to people so other people can learn from this type of stuff. And I think the Encyclopedia chart patterns, it doesn't get much better than that. It's about a 1,000-page book, guys, and the falling wedge alone is about 16 pages worth of information. So what I did, I wrote down the key points on a piece of paper. We got about 9 key points that I'm going to share with you. So guys, let's bring it home here. Let's do this. So this is the falling wedge, and what you're going to see here, what the Encyclopedia chart pattern says, it's a downward price spiral bounded by two intersecting downsloping trend lines. So that's what we're having here. These trend lines are both falling right there. Okay, and then it says the top trend line is typically steeper than the bottom one. So far we'd say 2 for 2 on this, and we're basically going to identify this and say, hey, looking at the Encyclopedia chart patterns, is this chart pattern right here, would this qualify as a legitimate falling wedge? Because you're also going to have broken patterns, which it talks about as well. So far we're 2 for 2. We have these downsloping trend lines. The top one is steeper in terms of its slope than the bottom one. The average rise out of this, so once you break out of this top trend line, we have a close up above it, which we had right here. The typical run is 32% to the upside. So that's the type of gains you can have. But what you want to do, you want to wait for that close on good volume up above this trend line here, and essentially that's a trend line break. You can look at it like that. Trend line breaks are one of my favorite things to play. I think they're very efficient. There's huge gains, huge profits to be made on trend line breaks alone, but you have to wait for that confirmation. So the volume trend, which we do not have up on here, it says volume trend typically down till the breakout. So it says 7 out of 10 falling wedges have a falling volume profile. So if there's volume here, most likely you have 70% chance that it would be moving to the downside before the breakout, and you want to see that breakout on heavy volume. I can't emphasize that enough. Heavy volume is the key. Guys, the next one here, multiple touches, and don't skip this one because you have to have at least 5 touches for this to be a legitimate falling wedge. Otherwise, it would not be considered. It'd be almost like one of those busted patterns that never really came to fruition. So what we have here, multiple touches. Most have at least 5 touches. Be skeptical of less than 5 touches. And what they're talking about here, so here's 1, 2, 3, 4 touches right here on this top trend line, and down here we have 3. So this is plenty. We have plenty of touches here, and also you don't want a ton of white space in here. You want a lot of chop back and forth in here where you're moving side to side. And you see these drops, so we touched that top there, guys, then we fell all the way back down. We came back up off that reaction. We did not get up to the trend line, came back down, tested it again, came back up, could not get through. And that's what's so important. You're seeing this where eventually we just get squeezed and squeezed and squeezed into an apex, and then eventually you're either going to break to the upside or you're going to break to the downside. And it's traditionally, guys, depending bull or bear market, typically it's about 70% to the upside and about 30% or so to the downside is what it's saying. All right, so here's another important one. This is the duration of the falling wedge. Minimum duration of 3 weeks. So if we're on the 1-day chart here, this obviously would be plenty, but you want at least 3 weeks forming of price action. And then what it also says is most likely, if anything is less than 3 weeks, it's considered a pennant. And also with these falling wedges, it rarely exceeds 4 months long. So say this is on the day chart as well, and we're bouncing along. A lot of the times these falling wedges will not last more than 4 months. If you're going in some 7, 8 months or whatever, it may not be a falling wedge. So remember, minimum of 3 weeks. Anything less than that is a pennant. And then, guys, it rarely exceeds 4 months long. Next one, tall patterns work better than short patterns. So they're saying like the distance here. So tall patterns are more effective than if it's a shorter falling wedge. So that's something that you want to keep in your back pocket as well. Look for those taller falling wedges as opposed to the shorter ones. Another very important point, pullbacks happen 69% of the time. So what they're saying is we break out of here most of the time, so 69% of the time you'll actually pull back onto this trend line, test it again, and then you'll move farther. Remember, those are the three options you can basically have. So you chop around in here until you get to that apex. Once you get to the apex, you're either going to be breaking up or down. Pay attention to heavy volume, either to the upside or to the downside. So guys, that's option number one. Option number two, you go up and then you actually pull back test that trend line and then move farther. Or you break out of here and then you have one of these busted patterns to where you actually fall back down through. So you can have those fake outs. And what the Encyclopedia of Chart Patterns says is basically look for some busted patterns in terms of that, like where they go up and then all of a sudden they start falling down through, because you can make really good profits to the short side there. But traditionally, guys, if you start to see this falling wedge on a 4 months like that and big volume comes in here and you break that trend line, that's something special. And that's when you know that you can run and have those 32% average rise. Now, the 32% average rise, that's in a bull market. In a bear market, you're going to rise about 26%. And that's why I love the Encyclopedia Chart Pattern so much, is due to the simple fact it takes all the percentages for bear markets, all the percentages for bull markets, and it talks about everything, the average rise, failure rate. And also, guys, one last thing that I forgot to put on here, pay attention to a 5% failure. So if we break up out of this and we fail to go up to that 5% or more, then most likely it's a failed pattern. So pay attention to that. You don't want it to go up less, breaking out of here less than 5%. So pay attention to all this stuff, guys. I'm really proud of each and every one of you being here with me, and I hope this stuff helps you. Really dig into yourself this falling wedge and go through some of the chart patterns and look. You'll see tighter ones, you'll see shorter ones, longer ones, all that type of stuff. But it's so fascinating when you truly dig in to these chart patterns, because you're going to see them play out a lot. And one that I saw play out just beautifully. One second here, guys. I want to grab a sip of water. One that I saw play out beautifully, now looking back, not a falling wedge, but just a chart pattern. Look at the descending triangle on Bitcoin. When we broke from that 6,000 all the way down to, what was it, guys, 3,100, something around that range. We had that flat bottom to where almost for 8 months or whatever, we kept coming down to 6,000. Then we'd have a reaction. We'd go up, come back down, 6,000. So we had this flat bottom, but we were having lower highs coming in. And when you have lower highs coming in like that, it's pounding on that bottom, just pounding, pounding, pounding each time, eventually until that bottom horizontal line breaks. And we broke to the downside. The trend was down, and about 70% of the time in a descending triangle, you will break to the downside as well. Sometimes you can break up, so we could have had that break to the upside, but there was just so much momentum, especially after a blow off top. We had a blow off top where it was basically a fifth wave blow off, guys, where the price of Bitcoin went from $10,000 or whatever to $20,000 in like a week or 2 weeks, and that's just not natural. And what a lot of traders saw there, that it wasn't natural, it was built on stilts, and they ended up taking their profits. When I was in this, I didn't understand any of that stuff. That's why I started studying so hard. I got in cryptocurrency as an investment. I said, hey, you know what, I'm hearing all these guys talk about hodling. I'm going to hodl for the next 4 or 5 years. I'm just going to buy some coins, lock them away, and then all of a sudden you start seeing this bear market happen, and you go, oh my goodness, I can't believe I didn't take profits. You're seeing lower highs taking place, and basically you're losing massive amounts of your portfolio. Bitcoin went down almost 80%, some of the altcoins down 95%, guys, and if you hodl through that, that's essentially like hodling through the Great Depression. In terms of altcoins, we crashed even harder than what the Great Depression loss was. So, this taught me more about bear markets. I really started to dig into books about bear markets and the chart patterns here, and I just said, you know what, this is never happening again. Fool me once, okay. Because I got in, guys, in April of 2017. So it was like basically where we're at now, it was almost the same prices and a lot of things of when I got in. When I got in, I saw Litecoin at like $40. I was seeing Bitcoin at $1,800, $2,000. And then it's like all of a sudden we had that huge market cycle. And then at the very bottom of the bear market there, we're at the same point basically where I got in. So, you want to be able to trade these things so you don't have to ride your portfolio down like that. And I've heard of some horror stories where people invested, $10,000 in, they saw their portfolio go up to $100,000 or whatever, and they didn't take profits. And they're kicking themselves. Some people didn't even pull out their initial investment, so they could have seen their portfolio go up to $100,000, and now they're looking at $3,000, back in the past there when we got to all-time lows, especially on some of the coins. So, guys, it's important to trade, and I'm proud of you guys being here, working hard with me, dig into the falling wedge, look into that descending triangle. I have some of those tutorials up in my playlist, and I really hope they can help you. That's my main goal here. I want to help people make good decisions. Remember, I'm not your financial coach. I'm not your advisor, anything like that. I'm here as someone to look to the upside, the downside, and hopefully be a positive influence here in the cryptocurrency space. So God bless you all. Take care, my friends.